Investors are closely eyeing some Fed speak today, with Cleveland Fed President Loretta Mester saying, "I suspect we may need to raise the federal funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening in financial conditions that has already occurred." Fed Governor Michelle Bowman echoed a similar stance, saying, "Inflation continues to be too high, and I expect it will likely be appropriate for the Fed to raise rates further and hold them at a restrictive level for some time." Now, notably, coming off of the most recent Fed decision, the signs pointed to even more of this focus continuing to be around November, of course, but in shifting and moving around of the dot plot, really showing us a little bit more inclination for many of the Fed members that we've continued to hear about over the later part of the summer, even into September, and now once again with a week of Fed speak on the docket, many of them kind of echoing that same stance. And we had actually, our own Jennifer Schallenberger had been able to speak to Susan Collins, and in that interview around the Jackson Hole Symposium in Wyoming, we had really heard the initiation of this kind of broader Fed speak in tenor, saying that I think it's extremely likely that we will need to hold rates for a substantial amount of time, hold interest rates at current levels, that is, for a substantial amount of time. Exactly where the peak is, they would not signal this far, or at least at that juncture, and it seems like that's still very much in the tape right now.
Yeah, certainly. Well, it's interesting when you compare what we heard yesterday from some Fed officials to what we're hearing this morning from Atlanta Fed's Raphael Bostic, and he is taking a dramatically different tone when it comes to what the Fed maybe needs to do or doesn't need to do in order to continue to combat inflation. He was just speaking moments ago, saying that there's no urgency for the Fed to do anything more as of right now. As long as inflation expectations don't spike, the Fed can afford to be patient. He also went on to say the policy is restrictive, and that's helping pull inflation down. And even just comparing what he's saying today to some of the comments that he made right around the September FOMC meeting. And he was really one of the advocates for the fact that the Fed does need to be a little bit more hawkish, that the Fed does need to do a little bit more in order to get a better handle on inflation. So what's changed between now and then? Still a little unclear. I guess we have gotten some data prints in terms of inflation. We'll get obviously a reading on the labor market on Friday when we get the jobs report. But still, at least for Bostic, he has enough, at least for right now, say that he doesn't see the need for the Fed to act at this point. That doesn't mean, though, that he says that the Fed is completely done from here on out.
And so it's a larger question of how this continues to show up for consumers and for businesses as well. One of the ways, and a few, if you look at this in three different directions. One, housing. You won't see people rush to make some of these housing purchases the same way that we had seen demand really jettison when you had a lower rate environment. So that is expected to still kind of remain status quo as it is for right now. Motor vehicles as well. You had Fed Chair Jay Powell talking about this late summer, saying motor vehicle inflation has declined sharply because of the combined effects of the supply and demand factors. Net, their policy actually working to dampen demand in vehicles. But what else could be at play here? We're looking at a critical, of course, holiday season where, as it's shown up in some of the consumer confidence numbers, consumers are even more so expecting a recession to come forward. Consumer fears of an impending recession ticking back up in this most recent consumer confidence reading from the Conference Board, consistent with short and shallow economic contraction anticipated for the first half of 2024. And then just lastly here, I'll throw a bonus one in there that could mean continued uncertainty, at least for the equity markets. That really ensued off of the September decision. And for the past few weeks, that's where we've been continuing. And even in the futures here, seeing a little bit of moderation, but to the downside right now.
Yeah, certainly. Well, Americans are starting to feel some of the sting here from the higher for longer potentially scenario, or the fact that we have seen so many dramatic rate hikes here over the last several months. We're starting to see consumers pull back on some of their spending patterns, what they're spending for, being a little bit more, tight with their budget. They're being forced to in this inflationary environment. The fact that inflation is still sticky and remains such an issue, obviously much longer than many of the forecasters had initially predicted.